How does inflation relate to unemployment? The Phillips Curve. Have you ever wondered how inflation connects to unemployment? The Phillips Curve offers an interesting perspective on this relationship. It shows an inverse link between inflation and unemployment. When unemployment decreases, inflation usually increases, and when unemployment rises, inflation tends to fall. This connection was first noted by economist A.W. Phillips, who discovered that low unemployment often leads to faster wage growth, which then drives higher inflation. On the other hand, high unemployment typically means slower wage growth and lower inflation. This creates a trade-off for policymakers. They face a choice. Reducing unemployment might lead to higher inflation, while controlling inflation could result in increased unemployment. For instance, an economy with 3% unemployment might see inflation around 6%. Conversely, if unemployment rises to 5%, inflation could drop to about 2%. This relationship is often illustrated with a graph, where unemployment is on the horizontal axis and inflation is on the vertical axis, forming a downward sloping curve. However, it is important to note that this relationship primarily holds in the short term. Over time, inflation expectations adjust. If inflation rises unexpectedly, unemployment may temporarily decrease. This happens because companies hire more workers as real wages fall. But as both workers and businesses start to expect higher inflation, they change their behavior, such as demanding higher wages. This adjustment shifts the Phillips curve. This leads us to the concept of the natural rate of unemployment. At this level, unemployment returns to a baseline regardless of inflation. Efforts to keep unemployment below this natural rate can cause inflation to rise without creating lasting job growth. This understanding is part of what is called the expectations-augmented Phillips curve. It suggests that in the long run, there is no stable trade-off between inflation and unemployment because inflation expectations change. If inflation persists above expectations, it will simply lead to higher overall inflation without reducing unemployment below its natural rate. From the inflation perspective, the Phillips curve shows how labor market conditions influence inflation dynamics. Low unemployment creates upward pressure on wages, which can increase overall price levels. Conversely, high unemployment eases wage pressures, reducing inflation. In practical terms, policymakers use the Phillips curve to balance inflation control and employment goals. Central banks may allow some inflation to lower unemployment but must be cautious. Pushing unemployment too low can lead to rising inflation. Understanding this relationship is essential for designing monetary and fiscal policies that aim for stable inflation while supporting healthy employment levels.